In this problem, we're going to kickstart creating our basic three-statement model. The task here is really simple. We want to first connect the income statement to the balance sheet. Go ahead and pause the video and give this a try, and then meet me back whenever you're ready. Okay, well, to get started, I am going to first take a look at my retained earnings and net income line items. So as a refresher, net income is a temporary account where we accumulate our profits throughout the year. And then at the beginning of the year, it all gets pushed to retained earnings. Now, my preference when creating models is to always just have net income refer to the net income line item on the income statement. And then retained earnings will always get accumulated from one period to the next. Let me show you what I mean. So I'm just gonna hit equals over here, and I'm gonna go to my income statement. And in January 2025, I'm gonna set this equal to this net income. Now for retained earnings, I'm gonna take the prior period's retained earnings and the prior period's net income. I'm going to now select both of these cells, copy, and paste it to the right. Now we can't really see what the effect is because we don't have our income statement populated. So let's populate some basic numbers. Let's assume that we did $100,000 in product sales and we operate on a 60% margin. So let's say 40,000 went to our product costs. Let's just assume we spent about 1,500 in advertising and maybe another 1,000 in rent and salaries and wages. We have a team where we pay 5,000 in gross wages, about 20% of that in taxes. Actually, it's more likely that it will be 10%. And let's just say 8% for health insurance and maybe $50 for payroll processing fees. And I think everything else is good. So according to this, we did $51,550 in net income. Let's look at our balance sheet and see how that translates. Well, as you can see over here, our net income in January is now $51,550. Retained earnings every single month after that is the cumulative amount of our earnings, which is $51,550. So if I just put another 50,000 over here, you'll see that the amount gets accumulated as such. Now, we're not quite done. As you can see, our assets, liabilities, and owner's equity don't tie, and they will when we build our statement of cash flows. But let's first create our other connections, and that is going to be with our accumulated depreciation. So as we know, accumulated depreciation, similar to how retained earnings is an accumulation of our earnings, well, accumulated depreciation is an accumulation of our depreciation expense. So I'm going to take last period's accumulated depreciation, and I'm going to add this period's depreciation expense. And then I'll hit enter, and I will drag this all the way forward. Now for our accumulated amortization, we have amortization expense. So now for our amortization expense, I'm actually noticing that we don't have accumulated amortization on our balance sheet. So I'm gonna go ahead and add that. I'll just add a new row. So I'm just gonna select this row by hitting Shift and Spacebar and then Control+ in order to add a new row. Let's call this accumulated amortization. And I'll start by just copying these values to have 0. Okay, so now for accumulated amortization, I'm gonna do the same thing. I'm gonna take the prior month, I'm gonna go to our amortization expense and I'm going to add it as such. And now I will copy and paste this forward. So let's just see, if I had a depreciation expense of 500 and an amortization expense of, let's say, 200, I could now see the cumulative impact of that over here. $500 on accumulated depreciation, $200 on accumulated amortization. Okay, so now we connected our income statement to the balance sheet. What's left is for us to now create a statement of cash flows, which we'll do in the next video.